Risk manage Risk management is the systematic process of identifying, analyzing, and responding to uncertainties that can affect an organization's objectives. In today's dynamic and competitive business environment, effective risk management is essential for organizational survival and growth. First important points of risk management is ensures a financial stability, minimizes financial losses. Risk management helps organizations identify potential financial risk such as market volatility, credit risk, and operational failures. By anticipating these risks, firms can take preventive measures, thereby reducing unexpected losses and protecting profitability. Financial risk management help organizations to protect cash flows, earnings, and assets from unexpected losses. Objective are reduces volatility in profits, prevents financial distress, and improves long-term sustainability. So we will discuss about how to control loss. Loss control refers to efforts that reduce expected losses. For example, personnel who drive slowly and cautiously reduce their expected accidental losses, because loss control usually involves investment of resources that are funds, efforts, or time. Finding the optimal level of loss control require considerations of both the benefits, lower expected losses, and the costs of additional loss control activities. An important dimension of this problem is the identification and assessment of the types of amounts of losses that particular activities can produce. We begin this chat by illustrating the different types of loss control with individual and business examples. These discussions also highlights that loss control decisions involve trade-offs, sometimes difficult, between the benefits of loss control and the costs of loss control. Recall from that expected losses can be calculated by multiplying the frequency of losses times the severity of losses. Consequently, a useful way of categorizing loss control activities is to distinguish activities that alter the frequency of losses from those that alter the severity of losses. Of course, some activities influence both the frequency and severity of losses. How to prevent loss? Numerous activities reduce expected losses by reducing the frequency of losses. Loss prevention. For instance, a family that builds a fence around their yard reduce the probability of their child being hit by a car or drowning in a neighbor's pool. Means you can build a fencing in your garden to protect yourself or to reserve your area. Okay. Farmers also use fencing system in their farm also to avoid attacks of animals to their crops. The cost of the loss prevention is the cost of the materials for the fence, the time spent installing the fence, and any reduction in the beauty of the landscaping. The benefit is the reduction in the probability of a child being injured or killed. If families makes a decision on whether to build a fence based on the cost and benefits, then families with smaller children, families with more income, families with neighbors who have pool, and families that live on busy streets are more likely to build fences. This example is given about to prove the to avoid losses of finance. Businesses reduces the probability of being sued under products liability law by designing, manufacturing, and marketing safe products. Safe products, however, generally are more costly because more careful design and more extensive testing takes time and money. Reducing the likelihood of a manufacturing defect increases manufacturing cost. Informing potential consumers about the safe use of a product increases marketing cost. The benefits of reducing the probability of a lawsuit include a reduction in expected legal cost, a reduction in expected injuries, and thus judgment for those injuries, and a reduction in the expected damage to the firm's reputation, which influences demand for the firm's products. If legal cost increase or monetary judgments increase, then firm can be expected to increase their investment in loss prevention. An extreme example of loss prevention is to avoid completely the activity that potentially gives risk to the loss. This form of loss prevention, which reduces the probability of loss to zero, is sometimes called loss avoidance. The cost of loss avoidance is the sacrifice of the benefits from the activity that gave rise to the potential loss. For example, if a firm avoids the probability of being sued by shutting down its operations, then the owners forgo the potential profits from the business. Presumably, loss avoidance would imply that the benefits from the risky activity are less than the cost of the risky activity. An example of loss avoidance is provided by the small airplane industry during the mid of 1980s. The damages from product liability suits increased sustainably for small airplane manufacturers, and consequently so did liability insurance premiums. From public policy perspective, a potential justification for the increase in damage was that the increase would induce airplane manufacturers to make safer planes. However, some manufacturers decided to avoid the potential product liability losses by going out of business. The expected revenues from selling small airplanes presumably were lower than the expected cost, including the expected product liability cost. An ironic consequence was that with fewer new airplanes being produced, people used older, less safe planes. In foreign countries, there are so many family that they are using their private jets or private planes, four-seater planes. Okay, we have know about the latest accident in Gujarat. Huh? The plane was totally new, and there was no any history about the crashes of that plane. It was the plane of Tata company. So it was technically sound plane, but the accident was done. Yet the causes of that accident is to be proved by the government because it was implemented by someone or it was a real accident. Loss reduction activities that reduce expected losses by decreasing the size of the loss conditional on a loss occurring are called loss reduction. They can occur before or after a loss. Pre-loss activities occur before a loss. They decrease the magnitude of a loss if one occur. For example, investment in firefighting equipment such as fire extinguishers reduces the magnitude of a loss from a fire, but this investment does not prevent a fire from occurring. Means you can purchase a fire extinguisher, but it will not be helpful to control the fire by itself. Okay, you must have to use that fire extinguisher cylinder to prevent on the fire. Okay, but nowadays there are few automatic system also available in that fire extinguisher cylinders. Means when if there is a problem of fire, it will be automatically activated and will be taken actions by itself. There were no need of any human to operate that cylinder of fire extinguisher. Post loss activities occur subsequent to an event that causes a loss. For example, placing plywood over windows that were broken in a storm can reduce subsequent water damage and these theft losses. Means you must have to invest or spend money to control these types of losses. Okay, and important types of pre-loss loss reduction activity is catastrophe planning to reduce the magnitude of losses from both natural catastrophes, that is hurricanes, earthquakes, etc., and man-made catastrophes, that is nuclear accidents, plant explosions, chemical spills, or terrorist attacks. Local, state, and federal governments, as well as many companies, have detailed plans for evacuation, medical treatment, power restorations, and cleanup. This planning can significantly reduce the magnitude of losses from catastrophe. The latest terrorist attack were implemented by the terrorists in Delhi. Diversification and expected indirect losses. Recall from chapter that diversification of a risk changes the probability distribution of losses in a way that keeps expected direct losses constant but reduces the variance of losses. In addition, diversification reduces the probability of very high losses, which can be measured by the maximum probable loss, because diversification does not change expected direct losses. It generally would not be considered an example of direct loss control. However, diversification can reduce expected indirect losses. We illustrate this point with an example in which a firm diversified risk by segregating loss exposures into smaller exposure unit. These types of diversification is commonly called segregation or separation of exposure units. We discussed about earthquake, natural calamities of earthquake in Japan and California is on high level. So they are not building their houses with cements and bricks. Instead of, they are building their houses with wooden furnitures and wooden things to avoid human losses or human damage in earthquake. Suppose that a firm has the choice of doubling the size of its existing plant or building a replica of the existing plant at another location. Assume that the value of each individual plant would be $50 million, and the value of one plant, if it were doubled in size, that is of $100 million. Further, suppose that both locations are exposed to losses from hurricanes. More specifically, assume that the probability of a hurricane at each location is 0.05, that the outcomes at the separate locations are independent, and that a hurricane at either location would result in a complete loss. In India, we always be saved from that types of hurricanes because of Hillary area. Hills are in India. Different types of hills are there around us. But what's happened in America? They have drawn the soil of that hills and made it totally ground level. Okay, means what's happened when the high level of air blowing from the sea level, what's happened? It creates hurricane, and that's for they are getting losses on high levels. If the firm doubles the size of its existing plant, it has a 0.05 chance of losing $100 million, and its expected direct loss is $5 million. If the firm builds separate plants, the hurricane loss distribution. Segmentation of the exposure units increases the expected frequency of losses from 0.05 to 0.0975, but it reduces the expected severity of losses. The latter point can be seen intuitively by noting that if a loss occurs, it equals $100 million without segregating, but generally equals only $50 million with segregation. The higher frequency and lower expected severity counteract each other in this example, resulting in no change in expected direct losses, that is of $5 million. Thus, in the example, the segregation of assets did not alter expected direct losses. But if there are indirect losses associated with a large direct loss, segregation of assets and other methods of diversification nonetheless represents a form of the indirect loss control. For example, if a dollar 100 millions properly lost but not $50 million loss causes the firm to incur financial distress costs and indirect loss, then expected indirect losses are reduced by the segregation of assets. Note that segregation of assets is not always optimal because of the associated cost. Separating the plants could decrease labor productivity, increase transportation costs, and increase overhead cost above any reduction in expected losses. Effects of insurance on loss controls. Since purchasing insurance coverage and loss control are alternative risk management tools, it is natural to wonder how insurance coverage affects loss control incentives. This is an issue that we have addressed on several occasions in prior chapters under the heading of moral hazard. The important point to remember is that provided insurance premiums are adjusted to accurately reflect the effects of loss control activities on expected insured losses, insurance coverage will not reduce incentives for loss control. That is, insurance coverage will not casual moral hazards. For example, a restaurant will have greater incentive to install flooring material that reduces slips and falls if its insurance premiums are reduced following installation of new flooring. However, in situation where premiums do not accurately reflect loss control activities, insurance coverage can cause moral hazards. If the restaurant gets little or no premium reduction, it may have too little incentive to modify the floors. Optimal loss control when cost and benefits are known. Loss control typically involves an expenditure of efforts, money and or time. The optimal amount of loss control ideally weights the costs and benefits, the reduction in expected losses. It is very important to reflect all the important benefits and cost in the analysis. This often creates difficult measurement issues, some of which we briefly discuss later in the chapter. The failure to do so will lead to suboptimal decisions and perhaps to too many injuries with severe consequences to victims. To illustrate the main ideas of comparing cost and benefits associated with the loss control decisions, we present two simplified hypothetical examples in which all the information necessary to calculate the potential cost and benefits is known. In practice, the magnitude of the potential cost and benefits would have to be estimated, which in some cases can be very difficult and often requires subjective judgment. We describe later how firms can estimate a sum of the cost and benefits of loss control. Remember that these hypothetical examples illustrate conceptual points related to cost benefits analysis. They do not incorporate all of the factors that would need to be considered in an actual situation. A simple example of safety expenditures. Suppose that a firm is deciding how much to spend to make its workplace safer. The first two columns provides a simple example of the effects of various levels of safety expenditure on the annual frequency of accidents per employee. For simplicity, we ignore insurance and assume that the firm's safety expenditures can be made only in increments of $5 lakhs. If the firm spends nothing on safety, then the annual frequency is 10%. If the firm spends $1 million, then the annual frequency falls to 7%. If the firm spends $2 million, then the annual frequency falls to 6.3%. Note the diminishing returns to safety expenditure, that is, each additional safety expenditure increments reduces the accident frequency by the smaller amount. I have given you a idea about the insurance companies, that is life insurance company and for governments general insurance companies, that are National Insurance Company, United Insurance Company, New India Insurance Company, and Oriental Insurance Company. You can take insurance, general insurance of human and goods also. You can cover your vehicles, your property in this general insurance, and you cannot believe that the insurance is available in very less prices, but we don't know because the agent of this company not promote these policies because it gives less commission to them, and you can pay only rupees 50 to 100 rupees for 1 lakh rupees insurance to this general insurance company for your human non-returnable policy amount. Means that amount is paid and will be used only after death or partial disabilities of human being. For example, cutting hands or legs in accident. Okay, this is counted as partial partial benefits. So you can also take this insurance of your family members from these general insurance companies. But for that, you must have to visit directly to that companies, general insurance companies, to take that low level insurance. That insurance is always sold out by the private company on the amount of near about 3,000, 5,000 to 10,000. We can't believe. So we must have this knowledge. Assuming that the average saving of accidents is $20,000 and that this property measure the value of harm to employee. The third column gives the expected accidents cost per employee. For example, when the firm spends nothing on safety, the expected accident cost per employee equals to $2,000. 0.1 frequency times means $20,000 in severity, assuming that the firm employs 5,000 workers. The fourth column gives the total expected accident cost associated with each level of safety expenditures. How much should the firm spend on the safety, assuming that the safety expenditure listed in column 1 are the only cost and that the reduction in expected accident cost is the only benefits. In companies or organizations, companies are taking group insurance for their employees to secure their life. Uh, Generally, accident is occurred in operational system, in production system. So they secured their employees' life to their safety to reduce the risk. Okay. Next point is protect shareholders' wealth. By managing risk effectively, firms can preserve and enhance shareholders' value. How? Minimizes extreme losses, stabilize market value of shares, improve investor confidence. Now in details. A business value is defined as the present discounted value of its expected net cash flows, where the cash flows equal cash inflows minus cash outflows. Thus, to calculate firm value, you must first estimate the firm's expected cash flows and then discount the expected cash flows using the appropriate discount rate. A simple example will illustrate how to calculate a firm's value. Smith Enterprise is a corporation that will exist for 1 year. It has no outstanding debt and the net cash flows per share of its common stocks at the end of the year are forecasted to be $100 if it does not lose a lawsuit. However, there is a 10% chance that it will lose a lawsuit that will cost $30 per share. We ignore taxes for simplicity. This assumption implies that the probability distribution for the firm's cash flows is as given below. The expected cash flow per share at the end of the year is $97. To find the value of Smith Enterprises today, we discount the end of year expected cash flow back to the present, assuming that the appropriate discount rate is 13.5%. The value of one share of stock in Smith Enterprise today is value equal to $97 divided by 1 plus 0.135 equal to $85.46. This is the value of Smith Enterprises without undertaking any risk management activities. In the subsequent sections, we will examine how various risk management activities might affect the probability distribution of cash flows, the discount rate, and thus the stock value of Smith Enterprises. It is important to emphasize that we are interested in the value of Smith Enterprises today, that is, prior to knowing what the actual cash flows at the end of the year will be. If you bought one share of Smith Enterprises today, it would likely cost $85.46. At the end of the year, you would expect the value of your share to be greater than $85.46. Means you will get a higher returns on that share. Specifically, you would expect it to be worth 13.5% more than $85.46. Since 13.5% is the discount rate used to value the firm, your actual return for the year, however, would depend on the firm's actual cash flows at the end of the year. If the firm's actual cash flows equal $100, no lawsuit, then each share of stock will be worth $100 at the end of the year. This will produce a rate of return on your investment equal to 17.01%. 100 minus 85.46 divided by 85.46. If Smith Enterprises cash flows per share at the end of the year is $70, then each share of stock will be worth $70 at the end of the year, and your realized rate of returns will be minus 18.09%. Means you purchased that shares at the rate of 85.46 minus 70 and divide by 85.46. Thus, you realized rates of returns will be either 17.01% or minus 18.09%. Means your share rate or wealth will be increased or decreased, which implies an expected rate of return equal to 13.5%. 17.01 multiplied by 0.09 into 18.09 multiplied by 0.01. This example illustrates the two fundamental determinants of value: the level and timing of expected cash flows and the interest rate used to discount each cash flows. More complicated examples that increase the number of years considered or that have more complicated cash flows distributions do not change these basic determinants of value. When examining the effects of risk management on value, we must examine how risk management affects each of these fundamental determinants. In general, the value of firm can be written as follows: value equal to summation of mean of expected net cash flow in year T divided by 1 plus R square, where R is appropriate discount rate. The appropriate discount rate is the rate of return an investor could expect to return on an alternative investment with the same risk as the firm's cash flows. It is important to emphasize that The appropriate discount rate depends on the risk of the cash flows because investors generally are risk our cash flows that are more uncertain should have a higher discount rate. The appropriate discount rate is called the opportunity cost of capital because it is the expected return an investor could have received had the person invested in a similar risk investment. Concept check. Assume Smith Enterprises end of the year cash flow is as described by, but suppose that the price of a share of stock is $90 today. What are the possible rates of return for the coming year? What is the expected rate of returns? Do two questions with what questions will be arrive. Second, compare your answer to part B of question 1 to the example in the text where the stock price today is $85.46 and the expected rate of returns is 13.5%. What does this example illustrate about the relationship between the expected rate of return on share of stock and its price, holding the expected cash flows constant? Components of the opportunity cost of capital. The opportunity cost of capital has two basic components. The first component is the return needed to compensate investors for the time value of money. The second component is the expected return needed to compensate investors for risk. Since the first component only reflects the time value of money and does not consider risk, it is equal to the return an investor could earn on a risk-free assets such as US government bonds. This return usually is called the risk-free rate of return. The second component is the additional compensation premium over the risk-free rate that is needed to compensate investors for risk. This additional expected returns is called the risk premium. As mentioned earlier, risk aversion suggests that as the cash flows become riskier, the risk premium increases. As we will see shortly, this intuition is correct, provided that risk is appropriately defined from the perspective of the investor. As an example, assume that the rate of return on government bonds, the risk-free rate, is 7.0%. If the uncertainty associated with the cash flows of Smith Enterprises causes investors to require a 6.5% expected return as compensation for risk, then the risk premium is 6.5%. Adding the risk-free rate and the risk premium yields a 13.5% opportunity cost of capital for Smith Enterprises. This is the discount rate that should be used when finding the present value of Smith Enterprises expected cash flows. If another firm, Brownie Brothers Incorporation, had riskier cash flows than the Smith Enterprises, the risk premium for Brownie Brothers would be higher than 6.5%, and the discount rate used to find the value of Brownie Brothers would be higher. The important point is that The opportunity cost of capital for a particular expected cash flow should reflect the uncertainty about the expected cash flow. Thus, the valuation formula equation 20.2 incorporates the expected value of cash flows in the numerator and the risk of cash flows in the denominator. Compensation for risk. The risk premium for Smith Enterprises in the previous example was assumed to be 6.5%. We now discuss determinants of the risk premium intuitively as the risk of the cash flows increases. One would expect the risk premium to increase because investors require compensation for bearing more risk. We must recognize, however, that some risk can be eliminated by investors at virtually zero cost by holding well diversified portfolios. If investors can diversify away some risk at zero cost, then they will not need to be compensated for the risk. Obviously, any security that provides compensation for risk then can be eliminated at zero cost will be highly desirable to well diversified investors. However, compensation among these investors will bid up the price of such securities, which lowers the expected returns until the investor receive compensation only for that risk that they cannot eliminate through diversification. Reduces impact of market volatility. Market risks such as interest rate, currency, and price fluctuations can be controlled. Hedging using derivatives, portfolio diversification, asset liability matching. Firms characteristics affecting risk retention, reduction of decisions. Conceptual reasons why firms might find it advantageous to reduce risk even when the firm's owners can reduce risk on their own through portfolio diversification. In short, the reasons given are that firm level risk affects the likelihood that a firm not only will have to raise costly external capital but also will encounter financial distress, which in turn affects the terms at which a firm's contact with lenders, employees, suppliers, and customers. We explained that firms might reduce risk because risk reductions is required by regulations of reduces expected tax payments. In this section, we use the conceptual arguments from the previous two drive implications about specific firm characteristics that are likely to influence risk reduction decisions. Risk retention refers to the decision to accept the uncertainty, variability associated with a particular risk exposure. Conversely, risk reductions refers to the decision to reduce uncertainty, variability. Our discussion of the retention decision assumes that the alternative to retention is to reduce risk using an insurance contract. However, the points generalize to other risk reductions methods that are discussed in subsequent chapters, such as the risk reduction using derivatives contracts, benefits of increased retentions, potential saving to a firm from increasing retention include saving on premium, loading, reducing exposure to insurance market volatility, reducing moral hazards, avoiding high premium that may accompany asymmetric information, and avoiding implicit taxes that arise from insurance price regulation. Improves decision making. By decision making, by evaluating potential risks and their impacts, managers can make informed and rational decisions. Risk management provides a structured framework that balances risks and returns, leading to better strategic planning. Risk management provides reliable information about risk exposure, supporting better decisions. Its objective is that helps choose optimal investment strategies, supports capital budgeting decisions, encourages informed risk taking. Conscious of the danger of ignoring uncertainties, companies are grappling with different techniques for analyzing and managing risks. This article provides a brief overview of some of the tools currently in use, among which are scenario, decision analysis, and real options, focusing on decision analysis. Its role in supporting decision making. For instance, decision trees, graphic representations of the issue at play can be useful in documenting and communicating uncertainty and risk. They may also generate new ideas about choice and enhance project value. Real options, for their part, are becoming increasingly popular, but present shortcomings is dealing with private risk, those that cannot be hedged on financial market. Ensures business continuity. Proper risk management prepares organizations to handle crises such as natural disasters, cyber attacks, or supply chain disruptions. This ensures continuity of operations and reduces downtime during emergencies, improves resources allocations. Risk assessment helps prioritize risk based on their severity and likelihood. This enables organizations to allocate resources efficiently towards managing critical risk rather than wasting resources on insignificant ones. Increases organizational stability. By proactively managing risk, firms can reduce uncertainty and volatility in operations. This stability improves investor confidence, employee morale, and stakeholder trusts, protects organizational reputations. Reputational risk can severely damage a company's brand image. Risk management helps identify ethical, social, and operational risks that could harm reputations and allows organizations to take corrective actions in advance. Enhances liquidity management. Effective risk management ensures that organizations can meet short-term financial obligations such as avoids cash shortages, improves working capital planning, reduces dependency on emergency borrowing. 10. Control cost of capital. Lower risk exposure result in lower borrowing cost and better credit rating. Means reduced interest rates, improved access to capital markets, better terms from lenders, facilitates regulatory compliances. Many industries are subject to legal and regulatory requirements related to risk management. Effective risk management ensures compliance with laws, reduces legal penalties, and protects the organization's reputations. Financial institutions must comply with regulatory requirements. Basel's norms for banks, SEBI and RBI regulations, solvency requirements for insurance. Non-compliance leads to penalties and reputational damage. SEBI means Stock Exchange Board of India and RBI, Reserve Bank of India. Minimizes credit losses. Proper credit risk management reduces the chances of loan defaults and NPAs. NPA means non-performing assets. Credit appraisal and monitoring credit limits and diversification. Early warning systems. Encourages a risk-aware culture. Implementing risk management promotes awareness among employees about potential risks and responsibilities. A rise aware culture leads to better internal controls and accountability at all organizational levels. 14. Facilitates strategic advantages. Organizations that manage risk effectively can take a calculated risk and exploit opportunities better than competitors. This provides a competitive advantage in the marketplace, improves long-term sustainability. Risk management supports long-term growth by ensuring that risks are identified and managed in line with organizational objectives. It helps organizations adapt to changing business environments and remain sustainable. 16. Sound business continuity. Risk management helps organizations prepare for adverse situations like stress testings and scenario analysis, contingency planning, crisis preparedness. 17. Enhance corporate governance. Financial risk management strengthens internal controls and accountability. Clear risk policies, defined risk limits, board and management oversights, builds competitive advantage. Organizations with strong risk management systems are more resilient, ability to absorb stocks, better strategic positioning, sustainable growth. And final, 19, improves transparency and disclosure. Proper risk reporting improves stakeholder trust, accurate financial disclosures, better communication with investors, and market discipline. Summary of this importance of risk is given here. Thank you. Today's session is over.